This key bond yield points to rate cuts this year. Janet Yellen warns catastrophic economic impact if the U.S. defaults on its debt. TLT shows bond market is worried too. The Treasury Secretary recently said that the government could run out of money as soon as June 1st. Yellen says raising the debt ceiling would be a way to show other nations that we are not a deadbeat country. Also, more than 2,000 U.S. banks are potentially insolvent, according to a Stanford finance professor. The U.S. is 3 weeks away from a possible default. The U.S. Treasury said that default could come as soon as June 1st if the debt ceiling is not raised. Even if it is raised, waiting until the last minute could be costly. This happened in 2011, the most volatile week since 2008. The result? The U.S. markets crashed, with the S&P falling 19% in just 3 weeks. In July 2011, waiting last minute to raise the debt ceiling would have massive implications. If it is not raised, even a partial default would result in a loss of 5 million jobs. Next 3 weeks will be intense. Why the bond market is worried about U.S. debt default risk right now, even though a key bond yield points to rate cuts this year. I will explain it all right after this.
How you like that? How you like that? Nah, look at you, now look at me. Look at you.
Welcome back everyone to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. And push my like button if you like what you see in today's video, because you're already a success. It is done when you join the Audacious Money Witch Club. This video is brought to you by my website. If you're a good boy, go to audaciousmoneywitch.square.site to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You want to be my client, don't you? The debt to GDP ratio is over 100% for the first time in history. The deficit is 6%. GDP growth is 1%. Debt is growing 5% faster than GDP in expansion. Any effort to rein in spending now will backfire and push the economy into a recession. Debt will explode again. The Treasury Secretary has continued to urge Congress to continue to raise the debt ceiling, and recently warned that the government could run out of money and trigger an economic crisis that will cost millions of jobs and roil the global economy as soon as June 1st. She delayed her trip to Japan this week for the G7 meeting in order to give an interview with ABC News on Sunday. Reuters reported, where she warned that Congress failing to raise the $31 trillion debt ceiling could cause an economic and financial catastrophe. There is no way to protect our financial system and our economy other than Congress doing its job and raising the debt ceiling and enabling us to pay our bills And we should not get to the point where we consider whether the president can go on issuing debt. This would be a constitutional crisis. Yellen told ABC News. A professor of finance at the Stanford Graduate School of Business presented a grim warning that the banking system dominoes are falling. In a New York Times opinion piece titled, "Yes, you should be worried. You should be worried about a potential bank crisis. Here's why." And collapse of several high-profile banks are most not likely to be an isolated phenomenon. He said, a damaging combination of fast-rising interest rates, major changes in work patterns, and the potential of a recession could prompt a credit crunch, not seen since the 2008 financial crisis. Rapidly rising interest rates creates a perilous condition for banks because of a basic principle. The longer the duration of an investment, the more sensitive it is to changes in interest rates. When interest rates rise, the assets that banks hold to generate a return on their investment fall in value. And because of the bank's liabilities, like its deposits, which customers can withdraw at any time, usually are shorter in duration, they fall by less. Thus, increases in interest rates can deplete a bank's equity and risk leaving it with more liabilities than assets. So it's no surprise that the U.S. banking system market value of assets is around $2 trillion lower than suggested by their book value, when the entire set of approximately 4,800 banks in the U.S. is examined. The decline in value of equity is most prominent for mid-size and smaller banks, reflecting their heavier bets for long-term assets. Suru was precise about how many banks were burning through their capital buffers and were underwater. The estimate is shocking. Almost half of America's 4,800 banks. There is a telling decoupling between stocks and a closely watched treasury yield that reflects how investors foresee the Federal Reserve moving forward with monetary policy. Since the start of last year, there's largely been a clear tie between the 2-year yield and the S&P 500 returns. When that bond rate rises, the index of the largest public traded companies drops. And when rates stabilize, the S&P 500 climbs. That rate has been moving lower as investors anticipate rate cuts this year. However, according to Bridgewater's research, now we are approaching either a soft landing or the beginning of the third stage. Given current conditions and the cause-effect linkages, odds favor that there will be a third stage, and that it will most likely take the form of an economic downturn. And if that doesn't happen, inflation is likely to remain above central banks' targets. Recently, our estimate of inflation a year from now has stabilized and turned up a bit at about 3.5% in the US and 4.25% in Europe. That's not low enough to end the tightening cycle or to allow short-term interest rates to fall, because earnings have not yet fallen enough to produce a contraction in the labor markets. Earnings need to fall in order to induce layoffs, needed to cool the labor market and bring down wage growth, which is a prerequisite for a sustainable 2% inflation rate. After cooling late last year, our weekly reading of earnings growth has bounced rather than accelerating downward. Based on the earnings season, we can see it clearly. Earning recession is not here yet. Across the West proves more persistence than the market bulls have been praying for. We might be headed for something different and much worse. recession and sticky prices in some economies, stagflation. U.S. 3-month Treasury bills hit 5.2%. That is a 20 years plus record level. That was partially a reflection of fears. A U.S. debt ceiling shutdown will hit as early as next month, but also the reality of an inverted curve presaging recession. Warren Buffett told his audience at the annual Berkshire Hathaway Jamboree, "A downturn is coming. Get used to making less." He has been selling stocks this year. China's priorities have changed. It's no longer about growth to expand the economy and create jobs through exports, but about directing the economy towards rising domestic consumption. The simple reality is China is no longer the default, the cheapest to deliver manufacturer, and it will take years for new supply chains to establish that foregone production elsewhere as cheaply. Look at Apple trying to shift production to India. Based on the TLT chart right now, stagflation is much more likely than deflation at this point. And here is my client Teddy Eazzy's book, Wicked Pussy Perfume. It is a femdom novel and it's about money, stockings, and the stock market. Order your copy today. You are such a good boy for watching my video right till the end. Bye.